Hello, everyone, and welcome to another Wall Street for Main Street podcast. Today we have a returning guest. His name's David Gurwitz. He is the managing director of Charles Nenner Research. David, thanks for coming on.
My pleasure, John. I love your show, and it's my real honor and pleasure to be with you.
So right now it's March. It's basketball season. I know you're a big basketball guy.
Mm-hmm.
What do you think about the tournament so far?
It's great that teams that are expected to win, lose, as we've seen. That's the beauty of the NCAAs. And I think Kentucky's going to win, like most other people think. And I know you and I were talking before the show that their pro team happened to be in college.
Oh, yeah. Even Larry Brown thinks if they were in the Eastern Conference, they'd make it to the NBA playoffs.
Right.
So.
Yeah, I think so, too. It's interesting. I'm a little older than you. I was trained by Red Auerbach when I was 40 years ago. I'll be 60 next week. And I had season tickets when Larry Bird was a rookie. I was in law school at the time. So I kind of look at things. I grew up in the Bronx, and the guy that ran my schoolyard was a Polish kid named Richie Lovis, who was point guard in a high school called Power Memorial that had a 7'1" center named Lou Alcindor that I think changed his name to Kareem Abdul-Jabbar. You might have heard of him.
Oh, yeah, and I remember their great game against DeMatha.
Yeah, really? Okay. So
well, I read about it.
Yeah, he lost. They lost at DeMatha. That was the only time he ever lost in Washington. So I've been kind of a basketball guy my whole life. I see life. My kids always tell me I'm constantly using basketball analogies. I became a concert pianist. If people Google David Gurwitz, and I'm a concert pianist partly because I was a basketball player, and it's the same moves, dribbling and playing piano. And so it's funny we're talking about it in the context of markets, but markets also kind of move in patterns, just as music and sports, and those who excel in those things are really pattern people, which is why I think you're interviewing us, because we are considered in the world one of the top pattern recognition people to be able to come out with cycle and target analysis. But in one sense, it's all the same stuff: music, math, and markets, the big 3 M's.
Oh, definitely. There's always a pattern no matter what cycle you're in, especially the equity markets. And right now, the equity markets have like a weird, to me it seems like a topping process where there's wild swings each day after a run. What do you guys see with the equity market?
Topping process, big top in April. We think there's going to be a short duration down move, but longer term, this is a major, I say this year, major top, and the next several years sideways, followed by 4 years of ugly. And then the end of the decade begins a big rally going up much more than we are now. But we're hitting a wall like we've hit every 7 years for the last 7 years. You go back to 7 years ago, we hit a wall. 14 years ago, 21, 28, 2015 now. 2007 was the top, 2000. 94, obviously 87. So there's a cycle from the Greek word circle. And that's what we do, is we look at many cycles and we try and find where all of them are topping, not just one 7-year cycle. What about a 3-year cycle? What about a 18-month cycle? And when all those sine curves are lined up and they're topping, which is what looks like in stocks now, must be a top. We don't know why. It's funny, I'm going to be doing some podcasts soon myself, and one of the things we'll talk about is Monsanto. We called on Sunday a cycle top, and look what happened this week. The news came out with some carcinogenic chemical they have, which might not be the only one they have, and boom, it goes down. And we didn't know this. We just said cycles are topping. Now, of course, we said you want to sell it on a close below a certain level, but just the whole idea that cycles predict stuff and we don't know why or when is something that kind of surprises us as well, but it seems to work.
Yeah, when it comes to cycles, the one constant it seems like is human behavior. I remember doing a podcast with another cycle analyst, and he said our only individual choice we have is like where we're going to go for dinner, or how are we going to sleep, on our stomach or on our side? He said, collectively, there's not really a choice. If things just go in cycles.
Correct. I'll even say even more. Let's say you're going to have ice cream, and there's 2 choices, vanilla or chocolate, which I have occasionally gone for ice cream and made the decision. I prefer vanilla. God put vanilla taste buds in my tongue more so than chocolate. So do I even have the free choice about that? So do we even have free choice about dinner? You know what I'm saying? Like, that's the pizza place, you know. So he's right that we really, and it's the hardest thing for people to accept, that there is not as much free choice as we think. And the Fed doesn't run the show, and Warren Buffett doesn't run the show, and, you know, Goldman Sachs doesn't run the show. They may seem like they do, but the reality is past voting in the form of stock buys or sells, which is in essence all we do is look at price, is it's going to tell what's going to run the show in the future. And it's not so easy for people to accept.
Yeah, it's not. People like to connect things with action or a certain event instead of a cycle. One thing that's very interesting to me is how stocks and bonds, I would say since 2012, have risen in tandem. Bonds are generally the safe haven. Like '08, it went up while the stock market went down. Do you see bonds being a safe haven again, or will it come down with, or is it possible it can go down with stocks?
Well, that's a great question, John. Let's go to 1980, right? Rates were 17% and the Dow was 1,000, right? Today it's 2015, right? 35 years later. Dow's 18 grand and rates are 2%. 1, 2, 3, whatever, you know, in this range. If you bought 35-year investments twice, if you were able to buy a bond, one bond that would hold for 50 years, and you held it, it would be up a lot. You know, it was paying 17% at the time. Could you imagine buying a bond today at 17%? A good solid bond, no risk of default. It'd be worth a tremendous amount of money. The Dow went from 1,000 to 18,000. It's worth a tremendous amount of money. So both went in tandem up for 35 years. Therefore, there's no law that says they have to go up the same way, but there's no law that says they can't go in tandem. So you're correct in your question, and that's what we think, that they're going to be both down over the next 6 years. Not straight, but that's kind of the way it looks like it's going to go. And so, yes, now it just so happens we want to be long TLT now because we think people will jump into it, and we don't think the rates are really going to go up till September. The rate move will start then.
Well, Jim Rogers, I remember listening to him, and we had him on a couple of times, and he said this when it comes to dollars and bonds. He said, I still own them because rightfully or wrongly, they're still a safe haven. Mm-hmm. It does look like, based on your cycles, though, they might be losing that status over the next 6 years. Correct.
That's going to be very difficult for people to deal with. You know, that it's not so simple to when both their favorite things are going down. What do? Gold should be up. We think food prices will be up. Crude, even though it's come down, we did call the top 6 months ago. We think it will go back up. So it's not going to be easy for people. Now, yes, he's right. I mean, he's a smart guy. Obviously, he's right that people with money would rather hold bonds paying 1% than a money market or cash because at least they're sitting with it. They're not losing their principal. So that's the theory why people say bonds are not going to go up and rates are not going to go up because more people are holding them now than used to be in the past. Mm-hmm.
Yeah. So you just mentioned gold. A lot of people say there's one final low. I've heard some people talk about 650. We had Martin Armstrong.
Yeah.
And we had other people say 900, 1,000. Mm-hmm. Me personally, I don't know if I could see 650. Mm-hmm. I don't rule out any type of one more drop. What do you guys see for it? Gold is a favorite among our audience.
Really?
So.
Well, after I answer, tell me more about your audience. But we called the top in gold in 1900 after 11-year run-up. So it's been down for 4 years. I'm going to read you just a note we just sent to one of our clients. We have a basic service with our research that I don't know if you've seen, but I'll send it to you. And then we have bigger clients as well that want interactive, so we do that as well. And let me tell you what we just said about gold to give you an idea.
Mm-hmm.
of what we were thinking. Gold, we think we're going to be a bounce now for 2 months. We don't think it's going above 1,400 for now, which is what we've been saying for a while. And it could get one more knockdown from there. It could get one more knockdown from there. It could go to 800. That could be a wave 5 down because we look at Elliott wave also. And you don't know what's in. No matter anybody says, you don't know what wave it is. You think it is. And we see our cycles and our target are more important because we think that's more sturdy and more successful. But we do think longer term it's going to go way back up again. So, but can we get one more hit down? Yeah. But we had 11-year run up, and that's why so many Canadians and Aussies are having such a tough time because they kept buying in, and then they didn't get out, and so they're feeling depressed. We have clients all over the world, and many of them are just depressed. You know?
Oh yeah, with good reason.
Especially they didn't want to get out because after 11 years up, who wants to get out? Stocks have been up 6. Look, we called the beginning of the rally in 2009. We weren't long this whole time. Nobody's that smart. I mean, there are some people that were. We haven't been, but we've been right maybe 3/4 of the time on the way up here. Is it easy to get out of stocks now after 6 and a half run up? You know, not so easy. You know, biotech just had a blowout. And, you know, there's a lot of arguments why stocks should go because look at the alternatives. But cycles seem to suggest that the past patterns will repeat and that we're going to have a knockdown. Now, this next few years might be more sideways than complete knockdown. Following that, it looks like more of a knockdown. But especially with gold and silver, for some reason, those investments are more emotional to people. Don't you agree?
Oh, yeah, I would definitely agree. Oh, like when you buy gold, it's not just a lot of people who buy gold, especially now since sentiment's so bad. They're basically believe in a hard money philosophy. They believe the dollar is going down. They believe the U.S. will lose world reserve currency status, and that's why there'll be a panic into gold.
We agree that we call the dollar top for now with a dip and then a back up again and then a longer term dip. We called this 3 years ago. We said the dollar would rally for 3 years. Look what happened. It's rallied for 3 years. Mm-hmm. And so dollar, you know, that's a DXY trade for people who may not know. Look at that. Although there's, you know, limitations on that ETF as well. But I don't know, all this stuff about the dollar does this, gold does that. You know, gold goes up in inflation, it goes up in deflation. If you look historically. So it's not so easy to just assume because things are moving in one direction that based on the past, it has to go in the other, it continue. That's what the cycles are so helpful for because they keep you out of trouble when there's a top. Just get out. And you know, that's the hardest thing for people I find. It's the non-professionals, which I assume is most of your listener base, most of our client base is non-professional, emotionally difficult to get out. And then the first couple of times you lose some money, it affects you. It's an emotional thing. And we understand that because that's what markets are. It's not just PE and this. It's a lot of emotion.
Oh, yes, I definitely agree with that. And I always say one of the reasons, the trick is they say it doesn't sound this easy. It's not this easy in practice, but is to buy low and sell high. I think one of the reasons is when things are high, it's surrounded by great news, and people want to buy into great news. And when it's low, it's surrounded by really bad news. Like you say, gold's going to go up. There might be one more knockdown, but it's going to go up over the next couple of years. Right now, it's surrounded by, you know, horrendous move, higher interest rates, U.S. recovery, stocks surrounded by a U.S. recovery, pent-up demand from the bad weather. So I definitely say the emotion factor, and would you agree that also just it's the news it's surrounding itself with when it's high and low?
That's a great question. I appreciate it. That was always the basis of what Charles, when he started this 30-some-odd years ago, he was in medical school, and the professor said that people get admitted to insane asylums all around the world at the same time, and they don't know why. This is after he said that they put on more doctors during full moons because women give birth more during full moons. That made sense. But the next thing didn't make sense to Charles, and he didn't know anything about this. And he came to New York, and he saw Gil Cavuto, who was on Fox, I believe, starting his career, getting on, saying IBM was topping because of this. And since Charles didn't know anything, he said, just because you're saying that, you're an announcer, how do you know? You're giving news. And back then, believe it or not, that was the beginning of business news. You know, there used to not be a business section in the in the New York Times. It was,
wow,
you're too young. This is all pretty recent. So basically, if the cycle's topping, IBM's got to come out with earnings, the news will be, they can't repeat. It's, you know, they've had such great years. The cycle's bottoming, the news will probably be, this is just the beginning. They came up with a new software, a new hardware, which they just did. Well, actually, no, IBM, Microsoft just did. They came out with a pretty good laptop. And we think it'll just go gangbusters. Look, Apple was at 700, shot down under 5, right? It's now back up. I mean, this perception, were they a different company? No. But so that's the whole point. Like you're saying, that the news at cycle tops tend to be negative, and at cycle bottoms tend to be positive. And so, in effect, the cycles determine the news. And that's quantum physics, by the way, John. Quantum physics is not A implies B. Quantum physics, and I'm summarizing a not such easy thing to summarize, but I'm a bit of a math guy. B has to happen so A will show up. It's not A implies B. The effect is what is running the show, and then the cause comes afterwards. And we tend to think, no, the cause is first and then the effect. That's, in essence, one of the differences between normal thought and quantum thinking. And that's, to a large degree, what cycles are based on. That the cycles basically, the combined cycles, 50 cycles topping, not just one, not just a 4-year presidential cycle or a 3-month seasonal cycle, 50 cycles, 50 sine curves topping. It means all of them are topping, must be a top, we don't know why. So something that topped 2 months ago, 4 months ago, 19 months ago, as long as it's an equidistant top, had to be. So you're right that the news, to us anyway, the news reflects the underlying cycle without anyone knowing it. And we just try and track that so we're able to predict things.
Yeah, the best example is you were talking about how you guys know what's going to happen, but you don't know why yet. And I would say the best example was Crude, when you guys called the topic Crude around June. And a lot of people have said no one saw the Crude crash happening. Well, one person did, or 2 people, you, Charles Nenner, right. So I'm talking to them.
Right. You know, those darts were working good those days. I'm only kidding. No, that's how it works. We don't know why. And yeah, so let me go even further. Your listeners should write to us. Say they heard, David and John speaking, they get a free month of the research. Go to our site, watch Charles on CNBC 5 years ago, 6 years ago, when Crude got to 147, and he's sitting on CNBC, I'm 30 feet away, and he goes, we're going to have deflation. Now, you had Crude had gone from 9 to 147 over 7 years, 6 years, 8 years. I don't even, Do you think anybody thought it would go down to 120, let alone 100, let alone 80, let alone 60? It went to 49 6 months later. Now, I don't know if you know this, but this is not that long ago it happened. So the fact that it shows up for 3 years in the 93, 97, 102 range, 105, and then boom, gets cut in half over a short period of time. Why is everybody shocked? Because no one wants to assume the past can repeat. And secondly, this is not fundamental, whatever that word means. I haven't figured that out yet. We think cycles are fundamental. It's the only thing that predicts anything. And yet there's such a knock against it for reasons that I believe has got to do with anti-math. I'll tell you another reason, too. Keynesian economics assumes the powers of the politicians to change things. They say if we come in, we do deficit spending. So every politician wants to come in saying, I can do this. So the assumption is that the humans have power to overcome a system. And we're saying they don't have the power, and no one wants to hear that. When Charles was on CNBC years ago, he said Fed funds would go from 6 to 0. It's exactly what happened. Does anybody remember? Do they care? Would they come back and go, maybe you were right then? What do you say now? So we're used to that already. There's an inability to hear this type of stuff. You, at least, you're open-minded. You go and you start a great site, your own background. And I'm proud of you. And I have to express, the person that put us together has been following you and said, this guy came up with this really great site, great following, and, should be a huge success. And I'm really happy. We're one of the biggest firms in the world, and you're getting started. I'm happy to be on your show because of what you're doing.
Thank you. So it's not just me, though. Jason and Mo have done a fantastic job. In fact, they're the co-founders and brought me on a couple of years ago.
Yeah.
So I've been here for a while. So we all live in the D.C. area, so we see a lot that's going on in terms of the nation capital.
Right.
And, of course, none of them understand cycle work, so I can definitely say that.
No.
And in terms of D.C. and politics, right now, the whole Fed, the news lately has been the Fed raising interest rates. What do your cycles show on interest rates?
They will start going up in September. And let me show you a quick cycle. 1981, what were rates? 17%. 1952, the government was selling savings bonds at 2%. 2015, government selling savings bonds. I don't know. What's rates now? 2%, 1.5%. 60-year cycle. Went straight up for 30 years, came down for 30 years. It's going to happen again. By the way, 1920, rates were high. 1890, they were low. Different level, obviously. Civil War, rates were high. That is a cycle in interest rates. So 2040 will be the top, according to that. So there's not much anybody can do about it. Now, does it mean everything's going to fall apart because of it? No, because we think the stock market, after a not so pleasant next 6 years, will have a pretty big run in the 20s. So you'll see rates going up then and the market going up substantially then. So I keep telling our clients, try and hold on for the next 6 years, which is not an American mentality because, we like basketball. The Canadians like hockey. They can live with a 2-1 game. We like 130 to 119, So
yeah.
we want to win now. The answer is don't lose. That's kind of what our research focuses on, stops and things are topping now, get out and wait. And you don't need to look for the home runs all the time. Just don't strike out. And that's a more important thing. I hope your listeners can appreciate that. We've had enough experience with, thousands of clients and a lot of different types of clients. And, cutting a loss, avoiding a loss is far greater than the gain. Because if you really start with $1 million and you lose 10%, then you're down to 900. You got to make more than 10% to get back to where you started, and you're feeling depressed and down. And it's like a basketball team. If you're down by 20 points, you don't get 20 back right away. You cut it to 16, then 11, and then 4, and then you feel you can get back. It's the same thing with a portfolio. It affects your brain. And not just cycles and what to do, but the actual feeling you have in it. So our job, we feel, is to make people at least be aware to don't make a dumb trade. And if you do, lose 1%, put in a tight stop and it's fine. And that's something, not everybody thinks about, but that's our focus.
Yeah, that's a great point. And in terms of I know you like basketball, literally sometimes a bad loss can be like fouling someone who's shooting a three-pointer. It's been a while since I played basketball, but I still remember, don't foul them if they're shooting a three-pointer. Just put the hand up.
I got to tell you something. When I grew up, there were no three-point shots, and then the ABA came into existence, and they put in a three-point shot, which eventually the NBA did. And I went to a camp, and this is 1973, and there were two counselors that came. One was a guy named Julius Irving, and there's another guy named Walt Frazier. This is Kutcher's Sports Academy in New York, and I was 16. And Rick Barry came. I mean, this is what it was like back then. And he used to say all the time, the greatest joy he got was taking a three-pointer and getting fouled. So the guy would basically be giving up 4 points on one play. And he'd really depressed. The defensive player would really be depressed. It's hard enough just giving up a 3-point shot, let alone fouling him. And trading's the same way. If you really mess up, it's so hard to get back. I mean, we don't trade people's money. We just sell research. So it's kind of nice. I know the emotion involved with managing money is emotional. We try and remove the emotion, but it's something I think people need to think about more.
Oh yeah, and not only that, there's nothing wrong with if you think it's going up, but you're not sure where the market's going. Not just a stop loss, but you don't have to put in a big position. Put a small amount.
Right.
It's much better to have just a small loss than a huge amount.
I'll add to that too. The Americans, like here, we're long the Aussie. We've been calling it for a while. We called the Aussie and the Canadian to par when they were 66 to the dollar about 5.5 years ago. And they went past par. Now they both came down. We think the Aussie's a buy, and the easiest way to do it is an ETF called FXA. It's a bunch of letters, FXA, right? It's Aussie. There's FXEs, the Euro, FXC's Canada, So Americans, for some reason, in general, don't think about currencies other than our own currency. And yet, it's the biggest market. It's the currency market. And it's fairly easy to play now. And you can, so now we believe you should be long the FXA, long UNG for nat gas, long TLT, the bonds. This is what you get from our news service. And so, I appreciate our having the time to speak, and we're getting close to the end, but I think it's important that people be open-minded wherever they are to be thinking about looking at things differently, which is what we try and do. And also, don't be afraid to do stuff you don't understand. Because people say, I understand stocks. We don't understand anything other than the math of tracking patterns. For us to say we understand stocks or bonds or commodities, I don't understand crude. I just saw that, the numbers were topping. Does that mean I understand it? Not at all. I don't know how to drill, fracking. I mean, I have enough clients. I've learned it, but I think people should be open-minded about doing things they never did, and we're able to help them do that. So I appreciate you putting us on the show, and anyone wants to write to charlesnenner.com and say they heard David and John speak and they get a free month of the research, we would be honored.
All right. And last question, I'll do non-markets related. Who do you think is going to be in the Final Four? Oh,
I'm going to ask you, and then I'm going to respond to what you think. Who you think is the Final Four?
I would go Duke, Kentucky, Wisconsin, and it's hard to bet against Michigan State right now.
It's funny. Those are my 4, too. Now, those 4 teams, right, Kentucky, Duke, Wisconsin is they haven't been there that often. How often has Kentucky and Duke and Michigan State been there? A lot.
Yeah.
So, I go back, how many Duke teams have been there, how many Kentucky teams have been there. It's amazing that they, year in and year in, especially now with the kids leaving college. When I grew up, they played all 4 years. Kareem played 3 years in college. Bill Walton played 3 years in college. Pistol Pete, all the guys, they didn't leave early. It wasn't done. Now you get a year or two, it's a lot. LeBron didn't even go. Not that he needed to, So I agree with those 4. It's funny you should say that. I was thinking the same thing.
Yeah, it's hard to go against good coaches.
Right, who are good recruiters.
Yeah. So, last thing, I always do this. If people want to find out more about you, how can they do so? And just you can give them your website.
Yeah, charlesnenner.com. Right to the site. Say they heard me speak with you, and they get a free month of the research. Comes out Monday, Wednesday, Friday, and Sunday. Monday, Wednesday, Friday, we cover S&P. Let me read you the different categories now. S&P, the Canadian, the VIX, which is something people should really be trading, the volatility index, gold, silver, crude, nat gas, U.S. bonds, TLT, German bunds, and currencies, the euro, the Aussie, the Canadian, the yen, and then the euro yen. And we've been pretty good, so I think people would enjoy it.
Thank you, and I have to say this is a must. Anyone that's trading the markets, this newsletter is a must. So thanks for coming on.
Thank you, John. I look forward to the next one and continued success.